you have your Avenue Supermarts, you have your Nestle, your Titan, Pidilite, all these Asian Paints again. Is that a risk that people run? Because on one hand, numbers are not expected to be that good. But at the same time, they're trading at valuations. See first quarter, while how the paint companies, despite not the best numbers, they've managed to rally. How do you play this entire thing?
I think, Darshan, the gap between the relatively highest growth companies, the companies which are performing relatively okay, and the ones which are not, is actually the highest that it's been. And I think this is a global phenomenon. Yeah. Our global team actually put out a report earlier this month where they've said that the gap between the quality, relatively better performing companies versus the ones which are not is actually the highest since 2001. And I don't think it's very different here in India also. I think you're seeing that wherever you have a relative growth comfort, the investing community seems to have sort of rewarded them with a lot more. The valuations have definitely gone up a lot more.
Nestle is one of the stocks that you said that probably might be on the weaker side. Despite you believe that valuations again here is a concern, or you believe that
I think the simple point that we're trying to make there is that vis-a-vis the expectations, where Nestle was actually one of the companies last quarter which did a double-digit volume growth despite all the gloom and doom. We think that may be at a risk, and we might see something more moderate and see a high single-digit growth this quarter. And I think more importantly for the F&B companies, this is true that the commodity cost pressures are definitely have inched up QOQ. And therefore, the core earnings, X of the tax cut impact, might actually get affected vis-a-vis where the expectations are. I think that's the point that we're trying to make for this quarter.
A simple framework to think about that, the earlier question which you also asked, is say a couple of years back for say 15% growth on a consistent basis, suppose you were getting 40 times, and again it's any sector. Today for a much lower earnings, okay, at 10% earnings, you'll get the same multiple or higher multiple because earnings are scarce. It's not a problem with India. Okay. Even our global earnings forecast this year is 3% growth. So earnings is a challenge everywhere. So for consistent earnings, even if they are a little lower than what they were 3 years back, 2 years back, you are getting a higher multiple. Okay. But the point we are trying to make here is that suppose there is an expectation that, okay, this was growing at 15, now it's growing at 10, but suppose you get 0. That is when I think the risk on this, some of the stocks where people are hiding. Okay, there are 15 stocks where everybody is hiding. And that is where the risk is that 10%, which is a lowered expectation, if earnings actually come below that, I think that will be a risk to the multiple.